Hi, everybody. This is Peter Schiff. It's Friday, August 1st, 2014. It's been about a month since I recorded my last Schiff Report video blog, so I certainly have a lot to talk about, but I really want to limit the discussion to the events of this past week because it's been a very event-filled week. There's been lots of economic data that came out during the week, and of course, we've had a big week in the markets, at least big to the downside. The Dow Jones finished the week with its biggest weekly decline in 2 years. In fact, all of the gains of 2014 were wiped out this last week. So the Dow is now negative on the year. And we even had a bigger decline in smaller cap stocks, Russell 2000. Those stocks really, they led the market on the way up, and they are leading it right now on the way down. Now, what was the catalyst for this big sell-off in the market? In fact, technically, right, if you look at the outside month from July, where stocks closed on the lows, many indexes made new highs for the year during the month of July and then finished negative on the month near the lows. In fact, stocks went out on the day's lows on Friday, the lows for the week. Last chart pattern looking very negative, so we could be in for a more meaningful decline in the short run. Don't necessarily think it will be a bear market. I think it would be a bear market if the Federal Reserve did the right thing. But unfortunately, or fortunately, depending on your perspective, there's no chance of that happening. But the catalyst for the move down had to do with a lot of the economic news that came out during the week and speculation as to what the Fed may or may not do as a result of that news. I'm going to start talking about some of the more important news items, economic items that came out during the week. Now, there's a lot of economic data points that I'm not going to discuss. In fact, there are probably more economic releases this week than in any week in recent memory. Almost all the data was bad, by the way, and it's amazing how much of the bad data has been shrugged off by those who are still holding on to the fantasy of an economic recovery. This data should be enough to prick that bubble. But apparently more bad news is going to be necessary to do that, and that bad news is going to be forthcoming. But let's get to the news of the week. First of it, on Wednesday, we got the first look at second quarter GDP. Now, this number was one of the only supposedly good numbers of the week. And of course, I'm saying supposedly because, again, if you understand the number, it really wasn't good at all. The government's estimate for second quarter GDP is 4%. Now, the consensus estimate was for 3%. So this number beat the consensus. What they also did is they went back to the second quarter, which had been revised to minus 2.9, and now they revised it to only minus 2.1. So they upwardly revised the first quarter, and they came in with a better number for the second quarter. And everybody immediately was excited about this 4% number. This is great. We've got a 4% growth rate in the economy. This proves that the first quarter was a weather-related anomaly, and we can completely discount that minus 2.1% from the first quarter. You can't. You can't do that at all. In fact, if you accept the fact that the first quarter was negatively influenced by the bad weather in January and February, then you have to also accept that the second quarter was positively influenced by the same bad weather. You see, a lot of the economic activity that did not occur in the first quarter because of the cold and the snow was pushed forward. That activity occurred, but it occurred in the spring instead. So maybe in March and April. So while the weather depressed the GDP in the first quarter, it had the opposite effect in the second quarter. So you can't dismiss the first quarter and say, oh, we're not going to worry about that because it was the weather, and then celebrate the 4% growth in the second quarter without realizing how much of that positive number was also the result of the same bad weather that you're using to dismiss that bad number in the first quarter. See, what you really have to do is take the first two quarters and average them. You have to look at the 6-month period, and that will smooth out all the weather-related anomalies. And if you do that, if you take the minus 2.1 from the first quarter and the plus 4 from the second quarter, you average out at just below 1. 1% growth for the first half of 2014. That is way below what the analysts were forecasting when the year began. So there's no way you can jump to the conclusion that we now have a 4% economy when at best, maybe half of that 4% was simply the 2% we didn't get in Q1 that was pushed forward to Q2. But of course, the 4% is just a preliminary estimate. We know from past experience that it is highly likely that that number is going to be revised downward in the months ahead. In fact, maybe even significantly downward. In fact, I wouldn't be surprised at all if by the time the final revision is in for second quarter GDP, that we don't end up below 3%, in which case we would have missed the consensus forecast, not exceeded it. But of course, by then it'll be old news and people will forget about it. But that is likely to happen. But it's amazing how many people overlook the tendency of these numbers to be revised down when they want to celebrate this 4% number and pretend that it's indicative of the growth rate the economy is going to enjoy for the rest of the year. In fact, the second quarter, I think, regardless of how far they revise it down, even if they revise it down below 3, I think it's going to be the highest quarter for the year, and it's all downhill from here. Because in the third quarter, we're not going to get any weather-related boost. There is no pent-up demand that didn't take place in the prior quarter that's going to benefit Q3. And in fact, of the growth that we got in Q2, a significant percentage of it had to do with a buildup of inventories. And if businesses were too overly optimistic on the economy and they built up their inventories too much, they're not going to do that again. In fact, they're going to be liquidating those inventories. So I think, again, it's downhill from here, and we're going to have much weaker economic growth in the second half of the year than we did in the first half. Of course, the consensus is for this strong second half recovery, but we've had that same consensus for the past several years, and every single year it's been wrong. So I see no reason to believe that they're going to be right now when they've been so wrong in the past. That was the data we got on Wednesday. On Thursday, we got some very interesting data points. In fact, that's what really began the big decline. Because on Thursday, the Dow dropped by better than 300 points. And Friday, today, it dropped another 70 or so. But it closed near the lows of the day. But the real damage to the markets came on Thursday. First, we got the Chicago PMI number. Right? That was supposed to come in at 63.2. That was the estimate for Chicago Purchasing Managers. And the prior month was 62.6. So everybody thought the number would increase. The real number was 52.6, about 10 points below the estimate. It was the biggest miss ever against expectations. It was the biggest monthly decline in that number since the 2008 financial crisis. In fact, it's the second biggest monthly drop going all the way back to 1980. It was a terrible, terrible number. But I think what was worse for that, first let me get to the Challenger jobs numbers that we also got. Challenger grade comes out with their estimate of layoffs, corporate layoffs that have been announced. And the number came in at just under 47,000 layoffs. That's the biggest monthly jump from the prior month in over 2 years. And it's the second biggest number, second highest number of layoffs announced in a given month in about a year, 11 months. And of course, if you look at the jobs, where the layoffs are, these are high-paying technology jobs in general where you're seeing the layoffs. These are the kind of jobs we need. And unfortunately, these are the jobs that we are losing. But the big number, I think, that really started to slide on Thursday, and you can actually see the futures sold off the minute this number came out, and it was the employment cost index, which had been up 0.3 the prior month. The estimate was for an increase of 0.5, but it came in at up 0.7. Now, the reason this spooked the markets is because the Federal Reserve, the prior day, on Wednesday, when they concluded their two-day Fed meeting, and they announced another $10 billion taper. Now they're doing $25 billion a month, right? They also are looking at the labor markets. They're looking for slack in the labor markets. And this big increase in employment costs worries people that, hey, maybe the Fed is going to be more likely to raise rates because this indicates that maybe there isn't as much slack in the labor markets, and maybe there are some inflationary pressures building as evidenced by this big jump in employment costs. So maybe the Federal Reserve will raise interest rates sooner rather than later. That spooked the market and started the sell-off. Of course, all of this fear is misplaced. The risk is not that the Fed tightens or tightens sooner rather than later. That's not the risk, because that's not going to happen. The risk is that the Fed doesn't tighten at all, which is exactly what's going to happen, because they can't tighten. If the Fed actually tightens, the recovery is over, right? The recovery that is supposedly giving them the confidence to raise rates, right? It can't exist if they raise rates. In fact, if the Fed could raise rates, they would have already raised them. I mean, it's been over 5 years. They're still at zero, and they're saying rate hikes are a year away, maybe. Why? If the economy is recovering, why can't the Fed raise rates? Because if the Fed raised rates, we'd be right back in recession, because it's a phony recovery. That's what people have to understand. It's not real. It's only here as long as the Fed can artificially sustain it with cheap money. The minute they raise interest rates, that party's over, right? The stock market's going down, the real estate market's going down, and by the way, we had a plethora of negative numbers all week for the housing market. You can put a fork in this phony housing recovery because it's done. The market is going down. Housing prices are headed back down. Housing activity is slowing. I think a lot of layoffs are coming in construction because this market's grinding to a halt. And again, the Federal Reserve built its entire recovery fantasy on the foundation of a stock market bubble and a housing bubble, and the wealth effect associated with both, and both of those bubbles are losing air right now. The wealth effect is going to work in reverse. People still don't understand this predicament, right? Because if the Fed raises rates, well, then the markets go down and we're back in recession, which means they got to cut rates again, right? So if they raise rates, they have to lower rates, which means they can't raise rates at all. That's what people haven't figured out. So the real risk is not that they do raise rates, but that they don't, because they won't, and it's inflation that's going to run out of control, and the Fed will eventually raise interest rates, not because they want to, because they have to, because they have no choice, because the market is going to force its hand. Of course, by then, rates are going to have to rise substantially, much more than had the Fed done it on its own, and the damage to the economy will be much greater, the financial crisis much worse. But it was that hotter than expected employment cost number, right, that spooked the sell-off. Now, also, people are saying this is good for the economy, right? If employment costs go up, that means workers are earning more. That must be a positive. Well, not necessarily. Number one, a lot of those costs are benefits. Healthcare costs are going up. It doesn't do a worker any good if his employer has to spend more on his healthcare. That doesn't put any more money in his pocket. And of course, some of the increase is due to the fact that a number of states have increased the minimum wage. But a lot of people are going to lose their jobs because of a higher minimum wage. So some people will earn more money. Some people won't earn any money at all. So that's not a negative, I mean a positive. And then also, employment costs are rising, but then so are prices. So just because you get a raise, if the raise is not as large as your increase in cost of living, you're not better off, so it's not necessarily good for the economy. You're still not keeping pace. And of course, these are not the only labor costs that employers face. There's a lot of costs that are not included in this measure. This is just wages, salaries, and benefits. It costs employers in many other ways, litigation-wise, regulatory, when you hire somebody. So it doesn't even capture all of the costs. But it is not good economic news. Costs are rising as a result of inflation and bad government policy, and it is not going to result in a stronger economy. But again, it was the fear that this will prompt the Fed to move sooner rather than later. Those were the Thursday numbers. Friday, today, suppose, we got the non-farm payroll numbers. And I think there was some fear, too, yesterday that this number was going to come in stronger. The estimate was for 230,000 new jobs created during the month. And instead, we came out with 209,000. That was shy of what had been estimated. And, there were people that thought it would be north of 250. The unemployment rate, however, ticked up from 6.1 to 6.2 because the labor force participation rate edged up from 62.8 to 62.9. So a few more people entered the labor force. They couldn't find jobs, so now they're unemployed. I mean, they weren't working before, but now supposedly they're looking for work. So now we're going to count them as being unemployed. So the official rate ticked up to 6.2. So now that's going in the right direction. That initially provided a little relief. We had a rally in the futures the minute this number came out below expectations because, again, this market lives and dies by cheap money, right? The only source of the rally is the cheap money, the QE, the 0% interest rates. You take that away, you raise rates, we're in a bear market. I don't care what the experts want to say. This market cannot maintain its current levels, let alone rise, without the Fed beneath it, because it's the cheap money that is providing the source of funding for the share buybacks, which is growing the earnings, and the fact that they can keep their debt financed is keeping those earnings up, and the fact that their customers can borrow so cheap so they can still buy their products. And of course, stocks are valued based on interest rates. It's a mathematical formula. The lower interest rates are, the more stocks are worth. If you raise interest rates, all else being equal, stock valuations have to come down, and stocks are not cheap. They're already expensive historically on a PE basis, and if you raise interest rates, they've got no place to go but down. But once again, the jobs numbers are actually a lot worse than the 209,000 headline number. And of course, everybody's going to talk about how this is the 6th consecutive month that we've had job growth in excess of 200,000, which is true. But again, we only report the net number of jobs that is created each month because beneath the surface, some jobs are destroyed and some jobs are created. The problem is the jobs that are destroyed are higher paying full-time jobs, and the jobs that are created are lower paying part-time jobs. So a lot of the addition, in fact, all of the net new jobs that are being created are of the latter variety, lower paying part-time jobs. But let me go into some of the demographics of this month's numbers. This is in the household survey, and they're breaking down the jobs by demographics. This is a very interesting statistic. So, in the age group of 25 to 54, right? 25-year-olds to 54-year-olds. This is the meat of the job market. The 24-year-olds, they've graduated from college, right? And up to 55, 54, you're in your peak earning years. These are the years where you're getting married, you're having kids, you're acquiring more skills, you're working your way up the corporate ladder, you're hitting, your peak earning period, right? Your 30s, your 40s, right? These are the people that we really need in the job market. In that demographic, during the month, there was a net loss of 142,000 jobs. 142,000 jobs. So people 25 to 54, they lost jobs during July. They didn't gain jobs. Who gained the jobs? The elderly. Although this is 55 to 69, so I hate to say 55 is elderly because now I'm 51 myself. But 55 to 69, the age group gained 159,000 jobs. Now, Janet Yellen is out there trying to say the reason that the labor force is shrinking is because all the baby boomers are retiring. Well, no, they're not. They're coming out of retirement to work. And why is that? Well, they're getting the 1-2 punch from the Federal Reserve, right? First, they're getting, the left-hand jab, right? Because, they get 0% interest rates, right? 0% interest rates means they get no yield on their CDs. And the right cross, to finish them off, is the fact that inflation is driving up the cost of living. Their food bill is going up. Their electric bill is going up. So they got the double whammy. What do? They got to get a job. They got to come out of retirement. Or if they were planning on retiring, they have to give up those plans and stay in the workforce. So younger people who should be working can't, and older people who should be retiring can't. That's the economy we have. Now, we also gain jobs. 16 and 19-year-olds gained jobs. They gained 44,000, and 20 to 24-year-olds gained 43,000. But what kind of jobs are the 16 and 19-year-olds getting? Hey, it's July. These are summer jobs. These are temporary jobs. Maybe they're part-time jobs. Same thing for the 20 to 24-year-olds. These are college students. They're still in school. They're getting part-time jobs. So this is a lousy report. Right? You've got older people who would rather not work that have to just to make ends meet. And, of course, they're probably not taking that great a job. The people that really need to be out there supporting their family, right, paying the mortgages, saving for their kids' college, saving for their own retirement, they're losing jobs. So this was not a positive number. Despite what the government wants to say or Wall Street wants to say, the jobs are really not there. And you know what? Going forward, the numbers are going to get worse. You know, we had a big drop. We created almost 300,000 jobs, like 290,000 jobs in June. So the fact that it's down to 209,000 jobs in July, that shows you that the trend is down. And in fact, some of the job creation that we got in the spring was in fact leftover demand from the fact that we didn't hire quite as many people in the winter as a result of the weather. So we got this one-time weather-related bounce. And again, it's a heads we win, tails you lose. They want to ignore the negative news and blame it on the weather, but they want to embrace the positive news and ignore the weather's impact on that, right? They always want to have it both ways when it comes to looking at the economic data. But that is not what's going to happen during the second half of the year. I think you're going to see a marked slowdown in job creation as the year progresses. And I think all of the economic data that we saw throughout the week is going to continue as we get more and more data regarding the economy. But again, the real risk is not that the Fed surprises everybody and tightens early. That's what people are afraid of. That's why the market is going down, because without the Fed, the market has no place to go but down. But that is not going to happen. The Fed is bluffing. This is all bark and no bite. It is impossible for the Fed to raise interest rates. If they could do it, they would have already done it. If they raise interest rates now, they destroy the very recovery that the low interest rates created. The problem is it isn't a real recovery. It's phony. If it was real, it wouldn't need the Fed's support. The only reason it does need the Fed's support is because it's imaginary. It's phony. Because the actual economy is getting worse. What the Fed is doing to goose the stock market and the real estate market to create this phony wealth effect is undermining legitimate wealth creation. All the money we're borrowing to spend is interfering with legitimate, genuine economic growth, and we're just digging ourselves into a bigger and bigger hole. You know, there was a guy on CNBC today, I forget who it was, but he was a big fund manager, and he basically said, look, Janet Yellen, the Federal Reserve, their real fear is deflation, and they're willing to risk higher inflation. Right? It's okay with the Fed if inflation is higher than 2%, which I agree with. But then he said the reason is because they don't have any tools to fight deflation, because they've already got interest rates at zero, so they can't lower them, and they've got an enormous balance sheet. They really can't make it any bigger. So they're very worried, what would they do if we have another downturn? Because, you know, they're basically out of bullets. However, he said that if we have too much inflation, well, that's an easy problem to solve because the Fed has a complete arsenal. It has lots of tools to deal with that. It can raise interest rates. It can shrink its balance sheet. Yeah, right. In what world can they do that without bringing on a worse financial crisis than the one that we had in 2008? This is what nobody can seem to put together. They can't connect these dots, even though they are enormous circles, and it's amazing that nobody can see them. But if Yellen just lets inflation get higher and higher and higher because she's afraid of raising rates, and it gets to officially 3%, 4%, 5%, What is the Fed going to do? How are they going to put that inflation fire out? They're going to raise interest rates up to 6 or 7%? That's impossible. If they're afraid to raise them now from 0 to a half because they're afraid of the damage they might do to the recovery, how much more damage would it cause if they had to go from 0 to 6? Because if they let inflation get to 4 or 5, they can't raise the Fed funds by a quarter of a point. That'll do nothing. That'll make the problem worse. They're going to have to jump out ahead of the inflation curve. They're going to have to abruptly slam on the brakes if they don't tap on them now. But it's all a fantasy that it can ever be done. Again, if the Fed raises rates because there's a recovery, there's no more recovery, and now they have to cut rates. But the problem is we're going to have the next recession, and the Fed's still going to be at 0. They're still going to have this bloated balance sheet. And again, it's not that the Fed is never going to raise rates. They're just not going to do it voluntarily. They're not going to do it as a decision. They're not going to do it until they have to. And it's not going to be a strong economy that's going to force them to raise rates, because I don't care how strong the economic data is, they ain't going to raise rates. And it doesn't matter how bad the inflation data is. They're still not going to raise rates. They're not going to raise rates until the dollar collapses, until foreigners no longer want to hold the dollar because they understand the predicament that the Fed is in. They understand that it is QE forever, right? That it is all just talk. There is no exit strategy. There never was, right? Because exit is too painful. This is the end game of QE, right? This is the all-in. This is the overdose. Only then, right, when the bottom drops out of the dollar and inflation really starts to take off, way beyond anything that you can rationalize. See, when it gets up to 3% or 4%, the Fed can still say, oh, it's okay. Don't worry, it's going to come back down. It's transitory. It's noise. They'll even say it's good for us. It's giving us a better buffer. But at some point, you can only get away with that for so long as it keeps going higher, and then the Fed will be exposed. Meantime, Janet Yellen, of course, there's an election in a couple of years. Janet Yellen wants to be reappointed. There's no question about that. And I don't think there's a Republican presidential candidate who, if elected, would reappoint Janet Yellen. So her only chance of getting reappointed is for another Democrat to occupy the White House in 2016. And the only chance of that is to try to keep this artificial recovery going just long enough to make that possible. Because if everything imploded before the election, just like it did on George Bush, it will be very difficult for somebody of the president's party to get elected. You see, the real estate bubble that the Federal Reserve inflated blew up before George Bush left office. And therefore, McCain couldn't get reelected. That's why Obama coasted into the White House, because the bubble burst before Bush got out of Dodge. Now, Janet Yellen understands this, so she wants to do everything she can to make sure that Obama's bubble doesn't burst until somebody else occupies the White House, or at least until they've counted the votes, right? Because she wants to get reappointed, and that's not going to happen if it hits the fan before the election. So she'd rather have it hit the fan after the election. And of course, the problem is the longer the Fed delays the inevitable, the worse it's going to be for everybody. Oh, I almost forgot to even mention gold. I mean, how could I go a month and then not even say anything about gold? Maybe because it, I guess, had a relatively uneventful week if you just look at where it started the week and where it ended the week, because it was pretty much unchanged, although it did have some volatility on Thursday and Friday. When that hotter than expected employment cost number came out on Thursday, the gold market sold off. Of course, it also sold off a little bit earlier in the week when we got the better than expected GDP number. But it had a much bigger sell-off on the hotter than expected inflation numbers. And that is the employment cost index. And you might think, wait a minute, isn't that counterintuitive? Wouldn't higher inflation be good for gold? I mean, don't people buy gold as a hedge against inflation? And so if the market is worried about inflation, why wouldn't that be good for gold? And the answer is because the market is not worried about the inflation, but what the Fed will do to fight it. You see, if inflation picks up and a central bank is determined to wage a war against that inflation and win that war, then the uptick of inflation could be bad for gold. But of course, that ain't going to happen. Janet Yellen is not going to wage war against inflation. She's already surrendered to inflation. It's just that a lot of people haven't figured that out yet. So because people think that Janet Yellen might raise interest rates sooner rather than later because of inflation, they sold gold. If they knew the truth, that Janet Yellen isn't going to care about the inflation, that she's just going to let it get worse because she is too afraid to challenge inflation for fear of what it will do to the economy, to the stock market, to the housing market, to the job market. So she is going to allow inflation to not only continue, but accelerate, and that is what's good for gold. Interestingly, though, while the gold market sold off on the bad economic data or on the cost data on Thursday, it recouped all of those gains on Friday. Not so for the stock market. The stock market went down a lot and then went down even more. So to me, that shows some resilience in the gold market, some underlying strength, and maybe is indicative of the fact that more people are figuring this out. In fact, even the dollar, which you would assume might have been a lot stronger based on the idea that the Fed would be more aggressive in its rate hikes, the dollar did inch up on the week, but it really didn't rack up any impressive gains. Yes, it is a bit higher, but not nearly as high as people would have thought who were bullish on the dollar. And if you accept this economic data and what the Fed is theoretically talking about doing at face value, the fact that the dollar wasn't even stronger and the fact that gold was so well bid at the end of the week, to me indicates that at least some people are figuring out what's going on and that are prepared to call the Fed's bluff. And on that note, that's it. And again, if you don't have to wait a month for these updates, I talk about the markets, the economic news every day on schiffradio.com. It's the Peter Schiff Show. Just check it out, schiffradio.com. I do the live show from 10 a.m. to noon. But if you are working at that time, just go to the website and listen whenever you want. You can get it as a podcast, listen to it in your car. But there's every day. And I'm sure in the weeks ahead, there's going to be a lot of stuff going on, a lot of things happening in the markets, and you're going to want to hear my thoughts. So make sure, again, go to schiffradio.com. Bye for now.